So there's been a recent trend here with videos on YouTube about when your dividend snowball really takes off. And those have been good videos, nothing wrong with them at all. But I feel like most of them really focus on the idea of getting past $100,000 worth of value in the portfolio. And from my perspective, I think they're missing the key point. So here's my unique perspective on when your dividend snowball, your dividend portfolio really starts to take off. The truth of the matter is, any dividend portfolio that you are consistently adding money to, that you are consistently staying invested and buying more quality dividend stocks, is going to eventually result in financial freedom. The big question is, when will that happen? And there are so many factors that go into that, including how much money did you start with? How much money are you adding on a weekly or a monthly basis? What's the yield of the dividend stocks in your portfolio? What's the dividend growth rate of those stocks? And maybe the most important factor, what is a reasonable amount of dividend income for you? Because every investor is different, and one investor might find a ton of value out of receiving $10,000 annually in dividends, where another investor might feel like they need at least $30,000 or $40,000 to feel like their portfolio is adding value. The reality is, it doesn't matter the value of your portfolio. That's right, you heard me correctly. The balance or the value of your dividend stock portfolio doesn't matter. What matters in a dividend portfolio are the amount of shares that you own. Because the income from your portfolio is not based on how valuable it is, it's based on how many shares of the underlying dividend stocks that you have. And for me, this is actually the beauty of a dividend portfolio. You don't need the dividend stocks in your portfolio to go up in value over time. They probably will, but even if they don't, even if they are stagnant, even if they lose some value, you still win. Because when the prices drop on your stocks, you get to reinvest your shares at lower prices, which means more shares. That means you get to reinvest your dividend income and additional contributions at lower prices, and lower prices means more shares owned. So in my mind, when I think about building a dividend portfolio, I think, man, I hope my shares go down in value. So that way I can reinvest at lower prices and collect more shares. Let's look at an example with Pepsi, ticker symbol PEP. Pepsi is currently priced at $179.79 per share, and they're a long-time dividend stock. Their current dividend, as you can see right down here, is $1.35 quarterly. Their annual dividend being $5.42, and their yield is currently right around 3.04%. Additionally, Pepsi, as you can see right here, has been raising their dividend now for 51 consecutive years, which makes them a dividend aristocrat. They also have really strong dividend growth rates right here in nearly the double digits, and they have strong revenue as well. So what if you bought Pepsi back in 1999 and you invested $1,000, okay? Starting balance $1,000, and you committed to adding every single week $25 to the portfolio to buy more shares of Pepsi, and reinvesting all of your dividends as you receive them back into more shares of Pepsi. Fast forward 25 years, where would the portfolio stand now? In the beginning here, your $1,000 would have brought you about 26.187 shares right here. And as you can see, the dividends in the beginning were pretty small here, $3.54 quarterly. And your $1,000 eventually grows over time. Let's fast forward 10 years. May 11th, 2009. Your $1,000 has grown to $16,000. Let's fast forward all the way to year 25. Okay, we'll go all the way down here to the bottom. Our $1,000 has now grown to $136,000. But during that time frame, you've only invested $32,650, or $25 every single week. And you're receiving quarterly dividends of about $950, $940, but growing every single quarter. Here's a look at that portfolio value. Over the 25 years, you started with $1,000 and it grew to $135,000 here. And here's a look at the portfolio differences for reinvesting dividends and not reinvesting dividends. And that's where you see the big difference here. The red line is when you're reinvesting all your dividends along the way, the true value of your dividend portfolio, and the green is where you're not reinvesting dividends at all. And you can see the big difference here starting after about 10 years, where you start to see a gap between them, and the difference between those two really starts to grow by year 15 right here. So the mediocre answer would be, with a dividend portfolio, you really start to see a difference after about 10 years. What if I were to tell you that you were leaving a crap ton of money? Not sure if that's a word, but we'll go with it. A crap ton of money on the table by running with this strategy. It's not bad, but what if you could do and accomplish so much more? This little pink line right here, this is without reinvesting dividends. And this red line right here is when you're reinvesting dividends, and that's great. But what about this green line right here that's just shot to the moon halfway through our 25-year time frame? What if we want to get that type of result? Introduce selling covered calls into your dividend portfolio. And it's when you really see a big difference. So in this example here, let me just show you the difference in the details. What I'm talking about is instead of just holding Pepsi and buying more shares and reinvesting dividends, which is great, but alternatively, what if once you reached 100 shares of the underlying stock, in this case Pepsi, you started selling weekly covered calls and collecting option premium and used that option premium to reinvest into more shares of Pepsi and doing that every single week? Well, I built a spreadsheet, of course, to show you exactly what is possible here. So in this column M, you'll see there's no difference in the number of shares you own at the beginning. You're still starting with $1,000 and you're still investing $25 every single week. And the number of contracts you sell is 0. Okay, because you don't have 100 shares yet. But once you do reach 100 shares, which does not occur until in July of 2001, so nearly 2 years into the process, you still haven't sold any contracts, no option premium, nothing like that. Once you start doing that, any option premium you receive goes into more shares of Pepsi. Now, to illustrate this here, what I did was say that for every week, based on the amount of option premium available for Pepsi, every week we can collect the equivalent of about 1/5 of a share of Pepsi, okay? Which is not very much, and I think you can actually do much better. Nearly 1/3 of a share, which means every 3 weeks, maybe 4 weeks, and it'll depend on the different dividend stocks. So I think it's a very conservative approach here. Every week, you get to collect 1/5 or 20% of a share. In column G right here, starting in this week right here, you collect 0.2 additional shares of Pepsi into the portfolio. And you'll see over time here, it makes a difference. So starting back in July of 2001, you're at 100 shares here. And then you'll notice that there's a gap here. It starts to form between normal shares and the shares with selling option premium. You're at about 2 shares difference here. Let's go to 2004, which is exactly 5 years into the process. Okay, we didn't start selling any options until a full 2 years into the process. So we go to May 2004 right here. We now have 218 shares instead of 185. And that's making a difference in the dividend here. Not a bunch, but $42 versus $50 quarterly. Okay, let's fast forward to 10 years in now, a full 10 years in. May of 2009, we'll go May 18th. Now we own 529 shares. Okay, and we would only own 322 before. So a full 200 shares difference. And also, by the way, once you have more than 200 shares, guess how many contracts you can sell? 2. And 300 shares? 3. So now we're selling 5 contracts here, and it makes a big difference. Look at our quarterly dividends gone from $145 to $238, nearly a full $100 more. And if we scroll over here, the portfolio balance is different too. We're at $27,000 versus 16. Let's fast forward to year 15, which would be 2014, way down here, May of right here. Now we're at 1,100 shares versus only 477. So now we're selling 11 contracts, and the difference here in dividend is significant. It's doubled, 312 versus 744, and our portfolio is worth over 100,000 versus only 42,000 if we weren't selling options. And then you might be thinking, well, that's already a great result, but the best part is still yet to come. The really big takeoff in this portfolio is just about to happen. Let's fast forward to 20 years here. It should be 2019 right here. Now we own 2,259 shares, and we would have only had 620 shares with the normal dividend reinvestment program. Furthermore, our dividend now is quadrupled, and well, not quite, but almost, $592 quarterly versus $2,166. And our portfolio is worth $305,000 instead of $83,000. So now we have triple the portfolio value, and all we've done differently is every single week we sell a new covered call. Oh, and by the way, we're now selling 22 contracts. Year 25, May 2024, we now have 4,403 shares compared to only 759. And our dividend is what? $950 quarterly versus $5,396. Now we have a $20,000 annual dividend. Our portfolio, by the way, scrolling down here, just so you can see the crazy part here, our portfolio balance, $791 versus $136. $791 versus $136. I mean, and this thing really blows up, by the way. If you adjust the amount we're contributing monthly, weekly here, if we go to the top here, and instead of 25 weekly contribution, let's say we made it 100. Now, with your normal portfolio, okay, of Pepsi, if you're just reinvesting dividends, all the way to the bottom here, you've got a portfolio of $519,000, $500,000, that's great. And you have 2,891 shares, and you've got about a $12,000 annual dividend, okay, in total dividend income, about $3,500 every single quarter, and that's going up, and that's great. But if you were selling options that whole time, in the end, you have 18,000 shares. It means you're selling 188 contracts potentially. And your portfolio value is, what, instead of $519, the normal way, now we're at $3.38 million. And total dollars investment for you is $130,000, as you can see right down here. Here's a look at that portfolio balance on a graph here. The green line is with options. You see things just really start to blow up here after 10 years right here, but really get the big separation starting within the first 5 years when you factor in the portfolio balance. But really the work is happening in the first 2, 3, 4 years, and really just starts to snowball from right here on, way beyond just reinvesting your dividends with Pepsi. And here's a look at the difference in share accumulation between the two strategies, right? Not bad here with red, which is just reinvesting dividends, but when you are running with options, things just really explode with how many shares you actually accumulate, which then translates into how many option contracts you can sell, which then leads to more and more and more income. Here's one last view I wanted to give you. This is the number of contracts you're selling with this option strategy. Notice here in the beginning, you're not selling any contracts. And then for a full year and a half, you're selling just one contract. And then once you get to 2, you're only doing it for about a half a year. And then every single time you increase, it lowers the amount of time you're selling just that number of contracts. You're increasing the number of contracts you're able to sell constantly, it seems like here. Once you're 9 years in, now it's only lasting about a quarter of a year, then you're increasing and increasing and increasing because you have so much income at play that's being reinvested into more shares. Now, obviously, I'm making a few assumptions with this specific example where I'm just assuming the number of shares, and it's going to fluctuate over time because the amount of option premium you get every single week might be a little bit different. There might be a few times where you have to roll your contract and collect less money or even pay a little bit of money to avoid getting assigned. There are certainly some details there, but on average, I believe that this is a very representative example of what is possible by selling covered calls on your dividend stocks. If you want to learn more about selling covered calls on your dividend stock, there's other videos I've made on the channel you can take a look at. If you want to learn from a great investor community, check out the Average Joe Investor Patreon community and the Discord chat. Lots of average Joe investors creating cash flow in their portfolios, selling covered calls on their dividend stocks. And of course, if you want to work with me one-on-one and have that environment where you can ask questions and go over things in a one-on-one type of setting, check out the link down in the description below. There's the exclusive access and the VIP access tiers as well. Hopefully you found some value in this video. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to as many comments as possible on the day I post a new video. That's all I got for you guys. Have a great rest of your day, and thanks for watching.